Thanks for joining us, Glenn. Another month where markets were dominated by central bank activity, it seems.
Yes, not for the first time in the past couple of years. Of course, central banks having a huge impact on markets. In March, we had the long-awaited move by the European Central Bank to start its asset purchase program, its QE program, which was as big and as good as the market expected. So they started that on March the 9th. They're buying bonds in Europe at the rate of 60 billion euros a month for at least the next 18 months. So very, very loose policy, and interestingly prepared to buy bonds on negative yields down to minus 0.2%. In contrast, the Fed, which ended its asset purchase program some little while back, has finally removed the word patient from its statements when referring to the first interest rate rise. And that again was a significant move for the Fed, indicating to markets that the Fed is keen sometime this year, June or September, to start the process of normalizing policy and raising interest rates. And of course those big divergent trends have had a huge impact on markets, both in March and so far this year. What have we seen? We've seen European asset prices rise very significantly. So bond yields have fallen to levels that we have never seen before across Europe, as the ECB is buying these bonds, alongside obviously private sector buyers too. Equity prices in Europe have moved up sharply. So far this year, in euro terms, the European equity market is up nearly 20%, including another good rise in March. Whereas in contrast, the US equity market has actually struggled to make any progress, actually down a little bit in March, sort of flat for the year to date. But arguably the biggest impact of these moves by central banks is on currencies, with the euro falling again, down 4% in March against the dollar, continuing its long decline towards a sort of parity type level. So a huge impact this month from central banks, and unlikely to go away anytime soon, this influence.
And what impact are you seeing of these policies on economic growth rates?
Well, it's interesting that we are now seeing evidence that the US economy is going through a bit of a growth pause here. It's struggling a little bit with exports. The oil price decline has had an impact on a significant part of the US economy as well. So all the evidence from the US is pointing towards slower growth, probably quite flat growth in the first quarter of this year. Whereas it's quite clear that in Europe and indeed in Japan, where you've had a similar policy from the central bank, ultra loose policy, zero interest rates, in Europe and Japan, we're seeing quite clear evidence that economic activity is picking up, albeit from a low base, but nevertheless picking up. So the surprises have been on the upside in Europe and Japan, on the downside in the US, and that is being reflected too in corporate profit results, where in the US they're flat. In Europe and Japan in particular, profit results are very strong. So that's been a further sort of drive behind this movement up in equity markets, with Japan doing actually very well in the first quarter, like Europe, not quite as strong in local currency terms, but because the yen was broadly stable against the dollar, in fact Japan in the first quarter of this year has been the best performing major market around the world in dollar terms, up about 10%.
And as you alluded to before, some extraordinary impacts these central bank policies are having on bond markets.
Absolutely extraordinary. We have an extraordinary situation in Europe now where there are about 10 European countries whose bond yields are in negative territory out to 5-year maturities. In Germany, you've got negative yields out to 8-year maturities, levels that we have never seen before. And of course, you've got this major buyer being the ECB, who's committed to buying 60 billion euros a month for the next 18 months and possibly beyond. So the concern in markets is, where will they find all these bonds? There's a sort of growing fear that there's going to be a shortage. And intriguingly, what we've seen this month is actually the buyers targeting high quality government bonds, mostly in Europe, but also pushing into other areas too, US and the UK, which have sort of are now viewed as sort of almost high yield markets. We're now seeing big buys of government bonds, whereas credit has seen some inflows, but at much lower levels. So actually, credit markets underperformed government bonds in March. High yield, for instance, produced actually negative returns in March. So a very clear trend there, where the big buyers have been in government bond markets at yield levels which are deeply unattractive, incidentally, on anything other than a very short-term view.
And how have emerging markets fared in this environment?
Well, we've had some quite interesting divergence there in emerging markets. Generally speaking, a period of dollar strength is not good news for emerging markets, as they typically borrow and fund in US dollars. What we've seen in recent weeks amongst the big markets is Brazil, although it's sort of stabilised a bit in March, actually falling quite sharply this year. The Brazilian economy going through a very tough patch. Inflation is high. Brazil's central bank being one of the very few in the world to have tightened monetary policy this year, whereas about 25, 30 central banks have eased policy. Russia has been under a serious cloud, although has rallied a bit in the course of this year, and the currency has stabilised a bit. Perhaps most notably, the Chinese market has actually rallied quite a lot, up about 13% in March, despite the fact the economy is going through, as we know, quite a significant slowdown. The administration now pointing to growth of around 7% this year, as opposed to 7.5% last year, and wrestling with this problem of some quite serious sort of medium to longer term headwinds to Chinese growth, and the unwinding of a credit bubble. The market rallied, I think, mostly because it was seeing the central bank in particular saying that it is quite prepared to ease policy, cut interest rates, ease lending policies on a quantitative basis, given this slowdown that we're seeing in the economy. So it looks a little bit sort of short-termish to me, that does, and somewhat dangerous at a time when managing this slowdown in China is a very difficult act.
And another area of rising, or potentially rising, geopolitical risk, intervention in Yemen by Saudi Arabia.
Yeah, that was actually pretty...
signs of further instability in the Middle East.
Absolutely, yeah. This whole problem in the Middle East is ongoing. And the intervention by Saudi Arabia raised the whole prospect of a sort of sectarian divide, sectarian warfare right across the Middle East, a real worry. And if Saudi Arabia gets seriously sucked into that, Saudi Arabia, by far the biggest oil producer in the world, producing over 10 million barrels a day, that would be pretty significant event, and markets would certainly be worried about that. It's pretty difficult to read how this is going to go, but it looks as if there's quite a coalition now forming around Saudi Arabia. Yemen itself is not significant in terms of its economy or oil production. It's Saudi Arabia that matters, so we're watching that very carefully. It raises the risks there, definitely. On the other side of the equation, it looks as if the West is coming close now to a deal with Iran on its nuclear program. And there'll be some steady reduction in sanctions in return for Iran curtailing very seriously its nuclear program. That, I think, ultimately is going to result in Iran supplying more oil into the global market, possibly as much as 1 or 2 million barrels a day in due course. So it's a bit of sort of positive news against what is generally a very uncertain, very unstable situation, and certainly not improving with this intervention by Saudi in Yemen.
Okay. And finally, what's your near-term outlook for markets?
Well, I think it's likely that these bond yields are going to remain pretty low, driven by what's happening in Europe. But they do remain, as I mentioned earlier, deeply unattractive, and that is a concern to us, but we could have a period of time yet where bond yields remain pretty low. Inflation rates remain low, and right across the developed world they're around either zero or even in negative territory. The big thing the markets are focusing on in the next few months is what the Fed is going to do. When is it going to raise interest rates for the first time in this cycle? The Fed statement, when they remove the word patient from its timing in terms of interest rate rises, was actually pretty dovish in the way that it reduced its growth and inflation forecasts and actually cut its expectations for interest rates over the next couple of years by around 0.5%. It looks to us it's still lower for longer is the sort of the best mantra for interest rates in the US, and it wouldn't surprise me if in fact the Fed didn't raise rates this year, given the fact that we've seen some quite negative numbers coming out of the economy in recent weeks, and the payrolls numbers just the other day were really quite a disappointment. So I think we're going to have quite a period here where rates in the US stay pretty low still, and even when they do go up, it's going to be very slowly, data dependent. I don't think we'll have a huge impact. So all in all, I think while bond markets look pretty unattractive, particularly government bond markets, I think equity markets have still got very good support from this continuing liquidity injection from the ECB, the Bank of Japan. We know they're intent on carrying on with their huge asset purchase programs for months and months and months, if not years. And we've got an environment where growth, albeit modest, is going to continue at this sort of pace for the next few years. So I think we're looking here at a very extended cycle, and I think equity markets can make further progress and go on to continue to exceed their sort of all-time highs recently reached in many cases. So there'll be periods of consolidation, periods of nervousness on the way, but generally speaking, I think equity markets are going to make further progress.
Okay, so cause for optimism.
Some optimism.
Brilliant, thank you very much.